Over the past day, U.S. markets surged after unexpected strength in non-farm payrolls, which showed a robust gain of 147,000 jobs. The three major indices responded, with S&P 500 and NASDAQ making solid moves upward. Investors shifted away from safe assets, embracing growth stocks. This momentum reflects renewed confidence in economic recovery. You, as a viewer, should sit up and pay attention because opportunities are emerging fast. Equity futures opened the day quietly but gained increased volatility near midday as traders balanced positions. Volume remained light due to the impending long weekend in the U.S. This environment can breed both risk and reward. Sharp moves may occur on low liquidity. It's important to stay alert and ready. The House advanced a massive $3.3 trillion tax and spend bill, triggering debate over inflation versus growth potential. This has led to bond yield upticks, with the 10-year U.S. Treasury yield rising notably. Equity investors are evaluating the implications: short-term stimulus versus long-term debt risk. Your portfolio should reflect both sides. Be strategic about repositioning. Global investors are navigating multiple catalysts this week, including U.S. payrolls, Europe's tariff deadlines, and key trade negotiations. Each of these events carries the potential to pivot markets overnight. Smart traders monitor triggers, not just trends. The coming days require disciplined positioning. You need to be proactive, not reactive. Optimism around a preliminary U.S.-Vietnam trade deal lifted markets, particularly boosting global consumer stocks. Brand names like Nike rallied strongly on the news. Trade clarity can unlock valuations rapidly. Domestic-focused companies will feel the impact next. As an investor, consider such macro catalysts in your buy zones. Oil prices softened slightly after signs of geopolitical friction in the Middle East, but traders held fire ahead of OPEC Plus meeting minutes. Stability in the oil patch can prompt consolidation trades. Energy portfolios need to be both patient and opportunistic. Watch for volatility spikes around the meeting release. Timing matters here. Gold saw increased safe haven demand amid mixed equity flows and elevated geopolitical tensions. Price ticked up modestly as investors hedged overnight. This suggests layered positioning across asset classes. Risk on, but not reckless. You might consider modest gold exposure as insurance. Bitcoin steadied inside the $105,000, $107,000 band after institutional inflows triggered a bounce. Digital asset buyers are returning following macro clarity. Crypto now acts more like a traditional risk asset. Its current behavior is strategic, not speculative. Pay attention to ETF and institutional activity. A BIS warning about stablecoin risks triggered a sharp sell-off in one issuer's stock, reflecting new regulatory pressure. This shows how rapidly sentiment can shift. DeFi markets are watching closely. A regulatory pivot may shape industry structure. Don't underestimate policy's role here. Markets reacted to renewed geopolitical strain after a White House Situation Room session over Middle East tensions caused a sharp equity drop mid-session. That sell-off reversed quickly as news flows calmed. Market resilience was on full display. Short-term traders can exploit such whipsaws. Remain vigilant for news-driven volatility. Fed Chair Powell's comments remained cautious, noting that future rate cuts hinge on trade and inflation dynamics. Treasury futures now price in September cuts more than July. The yield curve flattens further. Traders should read statements, not headlines. Your strategy should align with this evolving narrative. The U.S. dollar index dropped to a multi-year low as markets priced in persistent dovishness and fiscal expansion. Currency weakness boosts commodity-linked assets. Exporters benefit while importers pay more. Forex strategies must adapt quickly. The shift presents both risk and opportunity. Microsoft revealed 9,000 AI-related job cuts. signaling a pivot to technology efficiency. The news softened its stock yet emphasized future-focused growth. Big tech is reshaping itself and capital hustles to keep pace. Today's moves reflect tomorrow's leaders. Be part of that alignment. Tesla bounced nearly 5% on stronger delivery numbers in Europe, offsetting subsidy concerns. Despite volatility, investor appetite remains strong. Policy uncertainty is factored in, not ignored. EV momentum is intact. For now. Traders should watch earnings catalysts carefully. Japan's Nikkei strengthened due to fresh central bank support, delivering its best quarter since 1990. Capital is flowing into Asia on regional stimulus cues. Global investors see new growth hubs outside of the U.S. Diversify with intention. Regional plays demand smart sizing. China's factory sector contracted again, triggering expectations of Beijing stimulus. Manufacturing weakness casts macro shadows. Policy responses can be swift and impactful. Equity and credit markets will react. This is your cue to evaluate exposure. Australia's benchmark index rallied amid mining strength, despite softer consumer trends. Commodities are carrying regional markets. Investigate resource-heavy exposures. Sector leadership matters. Portfolio allocation should reflect that. Emerging market debt issuance hit records, with countries tapping euro, yuan, and pound bonds. This shift accelerates global currency diversification. Resilient debtor nations are rebalancing capital sources. Stay on top of FX-linked risk. Debt markets are evolving. European bond yields moved on UK fiscal news, with gilts recovering on political clarity. Bond traders are watching government stability closely. Fiscal politics are bond market scripts. Play them efficiently. Your yield strategy demands awareness. Looking ahead, upcoming U.S. non-farm payrolls, OPEC minutes, and trade policy updates could trigger significant moves. The next 48 hours are primed for major inflection. Position for reaction, not guesswork. The edge lies in readiness. Stay sharp, adapt, and win.